Viable investments thrive outside the stock market. You may be a new or an established investor and are looking for ways to invest your money, but do not wish to go through the rigidity of the stock market. You need to watch this video. The stock market is usually the first point of call for investors. This is due to benefits like higher liquidity, higher returns in a shorter period, and versatility. However, there are lots of other ways to invest your savings rather than just stocks, mutual funds, or exchange-traded funds. Diversification is the best strategy. Here are other ways you can invest that don't involve the stock market. The pros and cons of these ventures are well spelled out, so do watch till the end. Real estate. This entails making investments in residential and commercial properties. This is one of the most lucrative investment ideas since it is an asset that will increase in value over time. You can buy and then sell at a greater price, or you can lease to people. There are also ways to invest in real estate without directly owning physical properties. Consider a real estate investment trust if you're looking for ways to invest in real estate, but don't have the money or the time to do the extensive research required in purchasing the ideal properties. There are companies that own commercial real estate, including hotels, office buildings, and retail establishments. Due to their propensity for paying substantial dividends, REITs are a popular choice for retirement investments. Peer-to-peer lending. Through peer-to-peer lending platforms, you can invest in loans that will be made available to other people. You can provide modest funding, as little as $50, to support a customer's loan request, and you'll be reimbursed with interest as the loan is repaid. If the borrower defaults, there is a chance that you will lose your investment. You can, however, spread out small sums across several loans to protect your funds. This lessens your exposure to the financial status of just one person. You will lose everything if you invest in a loan and the borrower defaults. However, if you invest in multiple loans, multiple borrowers may default, but you are still protected. Open an account with a peer-to-peer lender like Loop or Lending Club to get started with peer-to-peer investments. Gold. There are several ways to invest in gold, including gold bullion, gold coins, gold mining firms, and gold futures contracts. Any buyer who is thinking about purchasing bullion or coins directly should ensure that they have a secure location to keep their investment, such as a safe deposit box at a bank. The Federal Trade Commission suggests that you should research any company you use to invest in gold before you buy, because gold prices might fluctuate. Even while it may seem like a benefit if the firm you hire will store the gold safely for you, it's crucial to deal with a reliable company if you won't be taking physical possession of the gold you purchase. When you invest in gold, you have excellent liquidity and a hedge against inflation. It is not difficult to sell gold. Every time you decide to sell, you will always get a buyer. However, exercise caution when purchasing gold jewelry. Due to things like contaminants, its worth does not increase. Additionally, investing in gold won't provide you with a consistent income. Other products must be included in your portfolio. Corporate bonds. Whenever a corporation or enterprise is in dire need of funds, which could be for diverse reasons such as business expansion or financing a project, it will typically issue bonds that may be bought on the secondary market or directly from the business. A bond pays interest over a certain period before maturing. The danger of the borrower defaulting affects the interest rates. Interest rates rise in direct proportion to risk. Holding a company's bond, in contrast to owning its stock, does not entitle you to any equity in the business. If the business goes exceptionally well, you won't make additional money. However, the amount of interest you are owed stays the same even if the business has a bad year. Your returns are therefore more predictable than those of stocks. Even though corporate bonds are frequently high safe investments, there are no guarantees in the event of default or bankruptcy. You could end up losing all or most of your money. Credit risk, interest rate risk, and market risk are additional hazards related to corporate bonds. The corporate bonds issuer also has the option of redeeming the bonds before they mature. Investors might not be able to find replacement bonds that offer the same yield when bonds are redeemed in an environment where interest rates are decreasing. Commodities futures. Contracts for future commodities such as foods like corn or grain and metals like copper are available for purchase and resale. You might gain a lot of money or lose a lot of money depending on the supply and demand ratio of each commodity. The fact that commodities tend to shield investors from the consequences of inflation is one of the main advantages of investing in them. Generally speaking, prices rise when demand for commodities is high during times of high inflation. Truly, investing in commodities can act as a hedge against inflation, but because many players in this market are fiercely competitive, you should proceed with utmost caution. You can also be exposed to market, credit, and volatility risks. Selling a lot on credit can bounce on you. In the same vein, a rapid price adjustment could be beneficial or fatal. Vacation rentals. Vacation rentals are gradually becoming an alternative to hotels. If you have limited capital, you could own a vacation home that you could rent out in your absence. In fact, you could also live there, but choose to rent out a section of the property. The most important is to ensure it's a furnished apartment. Nevertheless, ensure you carry out an in-depth market analysis to be well positioned and meet up with demand. Owning a vacation rental property is a great way to generate income for a short-term lease, but it also comes with the stress of maintenance and extra expenses. So, proper planning and adequate preparation are needed before venturing into it. Certificates of deposit. A certificate of deposit is a sort of savings account with financial institutions that provides a fixed interest rate for a predetermined amount of time. But if you withdraw your money before the term is out, you'll typically have to pay a penalty. Although the interest rates often fall short of long-term stock market returns, they are guaranteed not to depreciate. You can consider this option if you're sure you wouldn't be tempted to cash out your cash before the fixed date. 1, 3, and 5 years are typical terms. Certificates of deposit could be a wise investment if you're looking to safely build your money towards a specified goal within a set time frame. It has little or no risk involved. The best rates for certificates of deposit can typically be found at online banks and credit unions. Certificates of deposits are sold based on term length. Government bonds. A government bond is a type of debt that a government issues and sells to investors to fund public projects. This involves lending money to the government. This might be the federal or national government, which over a predetermined time frame, usually 1 to 30 years, pays interest to investors on the loan. Bonds are referred to as fixed income securities because of this consistent source of payments. Government bonds are essentially regarded as low-risk investments because they are backed by the government. Although the interest rates on these bonds may be lower than those on corporate bonds, the interest is not subject to federal income taxes. Venture capital. Venture capital entails lending money to new businesses to help them get started. The duration of venture capital is short. The goal is to make investments in a company's infrastructure and financial documents until it becomes big enough and establishes enough credibility to be sold to a corporation. This is a little related to private equity. The distinction is that it concentrates on startups. They are only accessible to accredited investors because of the significant risk. Large organizations that invest in venture capital include pension funds, financial institutions, and university endowments. They invest a modest portion of their total assets in high-risk projects. However, some new options like equity crowdfunding have created some limited opportunities for investors who may not be accredited. So, if you are a new investor, you can make more findings on venture capital. That will be all in this video. These are a few of the many opportunities that await you outside the stock market. As a prospective investor, you should make adequate research on these avenues and know which suits you. Real estate, among many others, has proven to yield substantial profits. You may give it a trial. Having a deep understanding of investment is crucial in our present world. This channel is committed to this purpose. Thanks for watching.